The Federal Reserve's rate cut and its impact on the U.S. and global economy. Hey everyone, welcome back to Global Dynamics Hub. Today we're going to dive deep into the Federal Reserve's most recent interest rate cut and explore not just how it affects the U.S. economy, but also how it impacts major economies around the world, including the European Union, China, and Japan. Let's start with a quick refresher. Monetary policy is how the Federal Reserve manages the economy by controlling interest rates and the supply of money. These adjustments influence inflation, employment, and economic growth. One of the most important tools the Fed has is setting the federal funds rate, which affects the cost of borrowing across the economy. In mid-September 2024, the Fed made a significant move by cutting its benchmark interest rate by 0.50 percentage points. This reduction was aimed at counteracting signs of a slowing U.S. economy, particularly in consumer spending and business investments, while inflation was showing signs of cooling off. The goal of this cut was to encourage more borrowing, investment, and spending by making money cheaper to borrow for both consumers and businesses. Initially, U.S. stocks surged, with the Dow Jones rising sharply, before falling back later in the day. Markets are often volatile after such decisions as investors digest the Fed's actions and try to gauge the future direction of interest rates. While rate cuts generally help the stock market by making borrowing cheaper, there's still uncertainty about how the broader economy will respond. For U.S. consumers, this rate cut means potentially lower costs on loans and credit cards. This could spur more spending in areas like housing, as mortgage rates may decline. Businesses also benefit from cheaper borrowing, which can lead to more hiring, expansion, and investment in new projects. Now, let's shift our focus to the bigger picture. How does a U.S. rate cut affect the rest of the world? The U.S. economy is deeply interconnected with the global economy, and when the Federal Reserve makes a significant change like this, it reverberates across the globe. In Europe, the European Central Bank, ECB, closely watches the Fed's decisions. The recent U.S. rate cut could put pressure on the ECB to take similar actions. Currently, the Eurozone is facing its own economic challenges, including high inflation and slowing growth. If the Fed continues to cut rates, it may lead to a weaker dollar, which could make European exports more expensive in the U.S. market, potentially hurting European businesses. However, lower U.S. rates could also make U.S. assets less attractive to investors, leading them to look to European assets for better returns. This can strengthen the euro and affect trade between the U.S. and the European Union. As a result, the ECB will have to balance its monetary policy carefully to keep the region's economy stable. China is another key player in the global economy, and it has been dealing with slower growth in recent years. The U.S. rate cut could ease some of the pressure on China by reducing the value of the dollar, which could help Chinese exporters. A weaker dollar makes Chinese goods relatively cheaper in the global market, boosting demand for Chinese exports. However, if the Fed continues cutting rates, it could spark a global trend of lower interest rates, which may complicate China's own monetary policies. The Chinese government has been focused on stabilizing its economy, but global rate cuts may prompt China to adopt more aggressive easing measures, such as cutting its own rates or injecting more liquidity into its financial system. Japan, with its ultra-low interest rates and persistent deflationary pressures, also keeps a close eye on U.S. monetary policy. The Bank of Japan, BOJ, has maintained low interest rates for years to stimulate its economy. A Fed rate cut could weaken the U.S. dollar relative to the yen, making Japanese exports more expensive and potentially harming Japan's export-driven economy. However, lower U.S. rates can benefit Japan in other ways. Japanese investors often seek higher returns abroad, especially in U.S. assets. If U.S. interest rates remain low, Japan may see less capital outflow, keeping more money invested within the country. Additionally, emerging markets might feel the ripple effects. Many emerging economies borrow in US dollars, and when the Fed cuts rates, it becomes easier for them to repay their debts. This could lead to more stability in these economies, although it also comes with risks if inflation becomes a concern. The Federal Reserve's recent rate cut is more than just a domestic move. It has global consequences. From Europe to Asia, central banks and economies are watching closely. Whether it's boosting exports in China, complicating policy in Japan, or influencing the ECB's next move, the effects of the Fed's actions are far-reaching. Thanks for watching. If you found this video helpful, be sure to like, subscribe, and hit the notification bell so you don't miss any updates on how global economic trends affect you.